So, welcome back to the financial accounting series. In today's class, we are going to understand a very important concept: uses of financial statements. So, whenever a business prepares financial statements, it is not just for the sake of preparation. These statements are created because different people depend on them for making decisions. So, today we will look at first thing who uses them, why do they use them, for what reasons, and what decisions. Users of financial statements are the individuals or groups who rely on the business's financial information to make decisions. So some users are inside the business and some users are outside the business. So we divide them into two broad categories. One is internal users and the second one is external users. So for the internal users, they are divided into so the internal users are the people who work inside the business and are directly involved in its day-to-day operations and decision making. So they need accurate and timely financial information to run the businesses effectively. So the first category would be owners, entrepreneurs, and shareholders. So these people, owners, want to know whether the business is profitable, whether it is growing, and whether their investment is safe. Financial statements help them understand profit, cash flow, assets, and liabilities. So, where comes to the management, these people use financial statements to make strategic decisions. For example, should they increase production? Should they reduce expenses? Should they invest in new machinery or not? How is the business performing compared to last year? So they depend heavily on financial information for planning and performance evaluation. So after management, we can say there are employees. Where it comes to the employees look at the financial health of the business because their salary, bonuses, and job security depend on them, right? If a company is performing well, employees feel confident about stability and career growth, right? So let's get into external users. External users are people outside the business, right, who do not take part in daily operations, but they still need financial information to make their own decisions. The first one would be investors. We can call them shareholders as well for large companies, right? Investors want to know whether the company is performing well and whether they should buy the shares, hold existing shares, or sell their shares, right? If somebody is wanting to buy a company or buy some shares of a company, the first thing they have to look at is financial statements. So they study profit, dividend potential, and long term growth before making these kind of decisions, right? So the second kind of users would be mostly banks and lenders, banks who provide loans, debt. So the first category would be equity, the second one is debt, right? Banks use financial statements to decide whether they should lend money to the business, because if the business bankrupts, then the bank is going to lose all its money, right? They check whether the business is capable of repaying the loans on time. The business is not going to default. They need this assurance before giving them before providing them with the debt or the loan. So they look at cash flow, assets as security, profitability, existing debt levels, right? So the third one would be suppliers, or we can call them creditors. right? So suppliers provide goods on credit. If you are not credible, then what supplier would give you, which supplier would give you goods on credit? So they will check your credibility. Will you be able to pay on time? Or were you good at paying debt on time? Before offering credit, they want to know whether the business can pay them back on time or not, right? And customers also do check the financial statements. Why customers do? What the hell customers have to do with the business? Yes sir, but everything has to do with the business. Customers are the main source of revenue, right? Customers, especially long term customers, care about the financial condition of the business. They want to know if the business can continue to supply products reliably in the future. So it's called trust. If you're building the trust, your brand is based on trust building. For example, a company purchasing machinery wants assurance that machinery manufacturer will stay in business for many years, right? And here comes the government and tax. The government uses financial statements to calculate taxes. Regulators also monitor whether the business is following accounting and legal rules. For example, SEBI does if someone is doing fraud or doing whatever, and our tax department does check financial statements if there is a scam like Satyam scam or not, right? And most important, competitors. Competitors also check the financial statements. These competitors are also the users. Competitors study financial statements to understand the market position, pricing strategy, right? What kind of prices our competitors are using, so that we can get better, we can give cheaper price, or we can give better service, right? And performance of the other businesses as well, right? And the last and most important, public. Sometimes the general public, media, analysts, or local communities also evaluate financial statements to understand the impact of the business of the economy, right? So, on overall, internal users are inside the business, external users are outside the business, but both depend on financial information for making decisions, right? So, why do different users need financial statements? What's the purpose? So, what's the purpose actually, right? Why do users need financial statements? Every user has a different reason. Every user has a different reason for reading financial statements. Some want to evaluate performance, some wants to check financial stability, right? And some want to decide whether to invest or lend or continue a business relationship. This is why financial statements are so important, because they help it decide and making decision.